All right, I'm Eric Lundquist, sitting here with Michele Brandt, and we're going to demystify the loan process. Michele Brandt from Fairway Independent Mortgage. How are we doing today?
I'm great. How are you, Eric?
Excellent.
Good.
All right, so I get like tons of questions from buyers of how this process works.
Yeah.
I usually catch up with a buyer when they start looking, so they have tons of questions. And I want to kind of ask those questions from their perspective so we can like figure this out.
Perfect.
So what do I need to do to get a loan? What do I need to provide?
So really the first thing that we need when we're looking at a loan is getting the pre-approval completed. And we basically break that into 3 easy steps. The first thing we do is get the loan application. Many ways we can get the loan application. You can do it on the phone if people prefer more of a dialogue where we can get some of those initial questions answered, things like that.
Sure.
I do have a downloadable mobile app that's really, really easy, user-friendly. Think Rocket Mortgage, but way better.
Yeah.
And then we've got a website where you can just apply right online if you're not a person that likes to use handheld devices.
Okay.
From the application, we pull a joint credit report and we make sure we get all 3 bureaus, Equifax, Experian, and TransUnion. And we're pulling a creditor's report, not a consumer's report. Credit scores do vary from each credit report, so it's important that you know when you're on a Credit Karma type website, you're getting the consumer report. The creditor report is the one that creditors that are looking to give credit to, that's those scores that we use.
So what's the difference?
So
The
consumer one is more of a, here's what your credit score kind of looks like, and they can be close, but I've seen them be 100 points off or more. The creditor one just has different factors that they look at. They're more heavily involved with, they're called hard pulls or hard inquiries. Mm-hmm. So if you had a hard inquiry, that's going to impact your credit more on the creditor side versus a consumer. You can look at your credit every day. So I think it's a really, really confusing concept. But just know that if you're on Credit Karma or any service like that, Discover, Capital One, they all offer it.
Right.
Those scores do vary, so it's important.
So don't be discouraged by what you see.
Absolutely not. I just had somebody that came in. They said I've only got a 605 credit score on the consumer side. This was a Discover card, and we pulled it. It was a 670.
So they
qualified. And they qualified for a down payment assistance program.
Oh, that's awesome.
So once we pull the credit, then we request a few documents. Most of the documents are tax returns, federal, W-2s, pay stubs, and bank statements. That's kind of the vast majority of W-2 hourly or salary wage earners and what we need.
Yeah. So if I'm going to quickly put together a couple of things to give to you, probably like this most recent W-2,
absolutely,
last 2 bank statements,
a couple of pay stubs and your tax returns. Yep.
And then boom, then you can run something.
Got it.
And that's a
pre-approval. Yep. That's the full-on thing. So once you go through that process, you're ready to get in your car and go make an offer on a house.
Okay, cool. So we talked about W-2. What if you're self-employed or you're work off sales commission? How do you work around those challenges? Yeah,
so that's a great question. I get that a lot. So frequently, or I will say the normal lending guideline is a 2-year average. There are exceptions to that rule. I've got loans that we can do it in 12 months with only 12 months of self-employed history, as long as it's similar industry. So I just had a client who's a fitness trainer, and they worked at a Snap Fitness making a salary, and then they just went on their own and became a fitness trainer on their own, and they just had a year of that income. We were able to do that loan even though she's only been self-employed for a year because she was a fitness trainer prior to that. So, but typically we look at full tax returns, 1099s if they had any, and then if they do an S-Corp, we'd need those business returns and K-1s as well. And it's a 2-year average.
Makes sense. So for the amount of house that I can buy, what's the connection between that and monthly payment? How does that work? So that's really what you're kind of boiling it down to, right?
Yeah, so once we gather all of the data for that pre-approval, you've given us a lot if you're the buyer. You've given us your application, your credit, and your documents. Mm-hmm. So now it's my job to analyze all that data, and we sit down and do a pre-approval meeting. We have about 30 to 45 minutes of conversation where we discuss, based on your criteria, here's the loan that you need or should get, here's the monthly payment based on your income, and here's the purchase price range. So when we qualify you, we get to use gross income. You don't get to pay your bills with gross income.
Right.
So we want to make sure that, it's more important to me that I know your budget's $1,200 versus you qualify for a $400,000 loan. Here you go with your $2,500 payment.
Right.
So it's more important to have just that dialogue going to know that based on your situation and what you're comfortable paying, that looks good. That's kind of the approach that I take instead of just, I got all your information, here's your pre-approval letter, go shopping.
Right.
With no information at all. Because maybe they only want the $1,200 payment but could afford a $2,500 payment.
Right.
Maybe we figure out a way to meet in the middle after they realize the expectations of a $1,200 payment and what that house looks like.
Right.
So
and
that's
that is what they're putting down and everything.
Absolutely, yeah. All of those factors. I mean, the number one call that I get that's kind of one of those calls, and not because I don't want to disclose the information, I'm an open book, but, you know, what's your interest rate? Well, your interest rate is literally based on 1,000 different factors. How much down payment do you have? What is your credit score? What kind of things do you do for a job? How long are you going to be in the property? You know, it's a million things.
Yeah.
So it's more important than just checking what the interest rate and fees are.
And what could a person do to lower that interest rate?
Improved credit is number one for sure.
That is the most influential.
100%.
Okay.
Yep. More down payment, surprisingly, could actually increase your interest rate.
Okay.
So I've got a borrower right now that's buying a $150,000 house. They're deciding if they want to put $25,000 down or $55,000, I think it was, down.
Okay.
If you lower your loan amount down to under $100,000, it's 0.5% hit on the back. So that can actually have a negative impact, more down payment.
But I could buy the interest rate down.
You can
too.
always buy the interest rate down. Yep. So when we've got open-ended cash reserves, or more open-ended than some, we'll look at those options the day that we're locking, or right around that time that we're locking, and determine, you don't want to buy down an interest rate if you're not going to be there for a long time.
Right.
I'll calculate out, that quarter point might cost you $2,000 and it saves you $18 a month. Well, that's going to take many months to recoup. Are you sure you're going to be there just to get to your break even?
Right.
So
yeah, it makes sense.
Yeah.
So for those that are I got a budget of $1,200, I could probably afford $2,500. What is the difference if they say, well, okay, let's extend a little bit further and spend $20,000 more on buying a home? What does that really end up meaning in like today's interest rates?
yeah, I always use the rough estimate, and this is pretty accurate. Every $20,000 is about $100.
Okay.
Either way.
All right.
So if you put $20,000 up to your purchase price higher, then you probably have $100 roughly increase in the payment,
so
and vice versa.
Because I get discouraged buyers who have lost 1, 2, 3, 4 bids against other buyers. Like, look, if you just went $10,000 more into a new world, maybe we can have a little bit better luck.
Yep.
That's cool.
Yeah.
So what's the difference? You said pre-approved. What's the difference between pre-approved and pre-qualified?
So I do not do pre-qualifications because I think they're worth nothing.
Okay.
I think if a buyer really wants to get the information and wants to be serious, especially in this market, they need a pre-approval. So pre-qualified is basically just, you're kind of like, oh, about how much money do you make? And you don't collect documents, you don't review, you certainly don't send it off to underwriting, which we do on occasion if we need to.
Okay.
You may or may not have pulled credit. You're just kind of, looks good. That's a pre-qualification.
Okay.
So anyone that says we'll pre-qualify you in 5 minutes or less, don't even waste your time, because you're not going to get what you need. So the pre-approval, like I explained with the credit, it sounds in-depth, but literally after our meeting, when you know purchase price, payment, down payment, go make an offer.
Yep.
That is the point that you're at.
And I'll tell you, as an agent, when I get 3, 4 offers on homes I'm selling, when I see pre-qual, pre-approved, that's a better offer. So I like
100%.
that. So in today's seller market, how should I be prepared to submit the most competitive offer?
Oh, that's a really good question. So a couple of things, definitely get your pre-approval done to know exactly what to expect. Get that done, even if you're 12 months out from thinking about buying a house. Just know. Why wouldn't you want to just know? Know the purchase price range, know the qualifications. Pre-approvals are good for 120 days, so they're good for a little while. But there's nothing worse than you're out on a Saturday with a realtor, you want to put an offer in on a house, and you haven't even started the loan process yet.
Mm-hmm.
Because it's not can we do them fast? We can do pre-approvals fast in an evening if we need to, but it's much less information based. It's much less like this is your payment range and this. It's just
Right.
here's your letter. It's a little bit more of a quick process.
Yeah.
So getting your homework done ahead of time with your pre-approval is super important. I will always call the listing agent just to let them know that I've had that pre-approval meeting with the buyer. I've talked about it. In some cases, if I do send the file to underwriting, I'll let them know an underwriter's already reviewed and approved the buyer. That's huge. So make sure that you work with someone that does that.
Mm-hmm.
And then, trying to figure out what the triggers are for that seller. We can always close loans in 30 days or less. I mean, there's not one loan out there on the market right now we can't close in 30 days or less. Speed of service is huge right now. If sellers need a 10-day closing, I've done them. We'll do them.
Okay.
Whatever we need to do to trigger point that seller. Maybe the seller needs a 4-month closing because they've got a house to build.
Yeah.
Whatever the case may be is just keying into that seller and then just putting a really aggressive offer together.
Got it.
I've got a lot of buyers too that are have one to sell, so it's a contingency question,
Mm-hmm.
and they really want to make that non-contingent offer. And so we get creative. How can we? Can we, first of all, do you
Yep.
know the risks that are outlined with that, carrying 2 mortgage payments? And then we just see what their options are.
Okay. So you mentioned a word a couple of times, underwriting.
Yeah.
What is exactly underwriting? What is that?
So there's a couple different ways that people in our industry talk about underwriting. So there's an automated underwriting approval system, which is AUS, automated underwriting system. And that is just a computerized system where you put all of the data that you have in. The credit report is analyzed, the application, and all the documents. You throw it into the system, it spins, and there's 2 systems, Fannie Mae and Freddie Mac, and it spits out an approval or not an approval. So you have to have, I will say most of the time, 99% of the time, you have to have that AUS approval.
Okay.
That's not really what I would consider underwriting because not a human has not looked at it yet.
Okay.
I mean, we've looked at it as loan originators, but
Yep.
A human hasn't looked at it. We've got at Fairway a pre-approval process. It's a 3-2-1 approval program. So we can actually send a file in, guaranteed underwriting turn time of 4 hours, and get that loan actually approved by an underwriter. So Fairway employs underwriters that look at the guidelines and make sure that this buyer qualifies for that mortgage that we're trying to put them in. And we can do that prior to them even making an offer.
That seems like it would be more competitive than if a smart
Absolutely.
real estate agent that's got a listing sees it.
Right.
Yeah.
Yep.
Okay.
100%.
Another thing you mentioned is if you get pre-approved, it's good for 120 days.
Mm-hmm.
If, like you said, they're 12 months out and they don't buy inside that 120 days,
Yeah.
is there a negative impact on their credit once that 120 days lapses?
So if the 120 days lapses, we won't automatically pull a new credit report unless we have their approval. So we'll
Okay.
just say, hey, how's it going? Your 120 days is up now.
Yep.
If you're getting ready to go shopping, because most people aren't like, today we gotta see a house. Let's go out shopping next week.
Mhm.
Then you call me or email me or text me and I'll pull another report. But we don't automatically do it every 120 days because that can have a negative impact.
Okay.
Credit scores that are higher, much less impact. But if your credit score is teetering on approval, that 600, low 600 range, you definitely don't want to pull unless you have to.
Over and over and over again.
You got it. Yep.
Okay. So there you go. Short list of exactly what they need again for that application process.
W-2s, last 2 years are helpful. Tax returns, last 2 years, 30 days pay stubs, and 60 days bank statements.
Pretty simple. See you in part 2 where we cover different types of loans and how those work and interact with each other.